the low of that is supporting and respecting the bodies, or the bodies rather are respecting the low of that. And then we displace there. It drops aggressively. And then you have your first clean fair value gap right there. See it? Right here? So it looks like this. This is not 9:30 candle. It's after 9:30. So it minimum is at 9:31. Yes, it's 9:37. So he has the ability rather to take that trade. He can take that trade. He can get short in that fair value gap. But what else is inside that range? If you're looking at this candlestick right here, to have that framed for a risk, where did it leave? This SIBI up here. So if it left this SIBI, when it does here, and it breaks and it gives you this fair value gap here, if we didn't have price so close to that SIBI low, the bottom of that rectangle shaded area, if it wasn't so close to it like it is here, on a day where it's already what? Indicating it's going to be high resistance. We already have indications that it's high resistance because there's a lot of back and forth price delivery. Do you think that Caleb would go in with max leverage in a trade like that? No. No, he would not. One contract, that's it. He has to start with one contract, but when he gets to the point where he can trade with multiple contracts on a day like this, he has to trade with one. Now, normally when you have the single candle in the middle that creates the fair value gap, you can use the high for that, for the stop loss. But because we're so close to the low of that range, that is the SIBI, this pink shaded area here, you have to use number one candle's high. And I've covered this in Mentorship 2024. When do I use the stop at the middle candle versus the candlestick that creates number one candle? A fair value gap is always three candles. Number one, first candle. Number two is always the actual gap, the range that doesn't share space between number one candle and number three candle. So if you're shorting, the low probability, I said it wrong. The low risk stop loss is using the high of a bearish fair value gap's number two candlestick's high plus one tick. But because we're so close to the low that it could very easily come back up here and touch that. It can retrade that at. Why? Why would we expect something like that as a potential event? Because of it being a high resistance liquidity run condition market. Versus if it was in a low resistance liquidity run condition, he could take a short in this fair value gap and then use the number two candlestick plus one tick as a stop. But as it is here, because of the conditions as it is for high resistance, it's a Monday with new news. It's already indicating a lot of back and forth, even though that we can see that it clearly has the ability to reach lower because of the clustered new week opening gaps and the 70% likelihood of trading and filling half of the opening range gap. So you have a lot of things drawing price down. But just because you think it's going to go down there and it's likely to go down there doesn't mean that your entry is going to be respected without having a stop out. So that means you have to use the maximum, which is the candlestick number one. It's high, and that would be here, plus one tick. That means you're inside of that shaded pink area. You're not getting stopped out here, Caleb, and you roll back underneath it, and then it comes back up and trades back to that fair value gap again. It's here, hits it, breaks lower, comes down, and there's your gap. 70% filled in the first 30 minutes, most of the time. Okay, I'll leave it to you if you think 70% is most of the time. I would consider that most of the time. 7 times out of 10, you're doing it right, and you have a favorable outcome. I think that's a pretty good odd. And I think many people, like, they are leaving comments in the section of X when I'm posting things, or in my comment section of my videos, which you don't get to see, but I see them a lot. One of the things that I find fascinating is people's excitement of how this phenomenon of half the gap being filled 70% of the time in first 30 minutes of trading, how often they're seeing that do it, and how often they're finding winning trades that are making them money. That's what it's all about, folks. Finding something that's simple, that doesn't have a whole lot of moving parts. I can complicate things. I complicated really 12 models in mentorship, paid mentorship. And I yielded those first 12. I have 2 of them that were kind of easy. They're real easy bread butter winners. But the others, I complicated them. I meant to do it that way because I had people in there selling my mentorship. I had people in there leaking my stuff. So I said, okay, well, let's see how well you do with sharing it, knowing full well that I would come back into them and strip them down and compartmentalize them and see what you have here. There's a lot of different smaller little models that you can use inside of those models. But what I was actually building is a great deal of refinement that most people will not be willing to subject themselves to. So many rules that are very specific that they're not going to want to do it. But they are profitable, absolutely profitable. But you have to sit and wait for very, very specific things. Now, contrast those 12 models with coming out here and looking at time-based models, because time is the first aspect to algorithmic price delivery. If you know that there's going to be a move in the first 30 minutes, and one of my students asked, do I subscribe to the idea that there's an algorithm at 9:30 that messes up price when there's no news? Well, the first 30 minutes is a script. Okay, so um, I don't want to say that it's a macro, but it is a script like every day, every minute of the day, unless it's intervention. The market is underneath AI. It's being delivered by a script. So the opening range, that's why I said there is no 15-minute opening range. Okay, I understand there's people out there looking like a used Q-tip. Okay, putting a lot of money into used cars. They'll say there's a 15-minute opening range gap. I mean, we're not gap, but opening range. There's no 15. The algorithm has absolutely no respect for the first 15 minutes. It's bullshit. I don't care what anybody says. But for the first 30 minutes and first 60 minutes,